Hey, what's going on, everybody? Do you ever wonder why people get so excited about investing in real estate? Well, if you do, this is the video for you here today because I'm going to go over 5 reasons why real estate is the ideal investment. And yes, it is an acronym. So IDEAL, ideal. That is income, depreciation, equity, appreciation, and leverage. And we're gonna get into all 5 of those right now. Let's go. So the first one is income, which is pretty obvious. Rental homes produce rental income. And when you purchase them property, they produce monthly cash flow. Cash flow is going to be the difference between what it costs to operate a property and what the home actually rents for. For instance, if you have a property that costs $2,000 per month to operate and the rental income is $2,400 per month, then you would have monthly cash flow of $400, which produces an annual cash flow of about $4,800 per year. Now, of course, that is passive income, meaning that you did not have to work to earn the income. In fact, your tenant had to work to earn the income so that they could pay you so that they could have a home to live in. Now, if we take this one step further and look at this through the lens of a business or a real estate investor, if you will, you can actually calculate your ROI and compare different investment vehicles. So if we use the example that I just mentioned, let's say that you invest $60,000 of your own capital into a piece of real estate that produces $4,800 per year in annual cash flow. Well, you can determine what they call the cash on cash return by simply taking your annual cash flow and dividing it by your capital investment. Now, if you take 4,800 and divide by 60,000, that will give you an 8% annual cash on cash return. Now, with that information, you can actually compare the risk versus the reward and how that 8% return compares to other investment vehicles like stocks, bonds, crypto, and things like that. Now, the second reason is depreciation. Now, this is actually a non-cash deduction that reduces taxable income. And it is sometimes referred to as a phantom expense because investors don't actually have to write a check. Now, you should always consult your accountant or your CPA on how this would work for your specific situation. In most residential real estate in the United States, property is depreciated over what they consider the useful life, which happens to be 27 and a half years. Now, the depreciation only applies to the building, not the actual land. So it's the structure only. So as an example, let's say you purchase a property for $400,000. The land is worth $150,000, which means the structure is valued at, let's say, $250,000. So you would take the value of the structure, $250,000, you would divide by 27 and a half, and that would give you a total dollar figure of just over $9,000 that you're able to depreciate each and every single year for the next 27 and a half years. Now, that depreciation expense can be used to offset your annual cash flow and actually reduce your tax liability. So it's a very, very powerful tool. Now, the third reason is equity. Equity is actually the difference between what you owe on the property versus what the value of the property is. So for instance, if let's say you owe $400,000 on a property that is worth $500,000, well, that delta, that $100,000 is what we call equity. And the beauty of real estate is that equity generally grows over long periods of time. And that happens in 2 ways. One, the mortgage is paid down, and then the property values tend to go up. Now, the fourth reason is appreciation. Home appreciation relates to a house or an investment property increasing in value over a period of time. Now, generally speaking, homes tend to be a good hedge against inflation, meaning the value of the property goes up as wages and the cost of goods and services rise. So over long periods of time, homes generally tend to appreciate in value because the cost of goods and services rise and wages tend to go up. Now, if you purchase the home with a fixed rate mortgage, your mortgage payment will stay the same while your wages and the value of the property go up, making your monthly payment cheaper and cheaper and cheaper. Generally, your cash flow will improve over time as well. And the fifth reason is that you can purchase a home using leverage. Now, this is the ability to use debt or a mortgage to purchase a rental property. So the bank essentially becomes your business partner. So an example of this is that the bank may require a 20% down payment to purchase a rental property, but they will lend you the remaining 80% of the value of a house. So if you were to purchase a rental property for $500,000, the bank may require $100,000 from you as a down payment, but they will lend you $400,000 in order to get into that property today, as opposed to paying $500,000 all cash in order to purchase that property. So it allows you to get involved and become a market participant much earlier. So now on a primary residence, the bank may only require a 5% down payment, and they're willing to lend you the remaining 95% to purchase that property. So even though we're discussing rental property in this example, there is an opportunity for those that are looking to get involved in the market and maybe purchase their first home. They can put as little as, let's say, 5% down, get into the property, live in it for a couple years, and then eventually turn it into a rental down the road. Now, the ability to use leverage in the form of a 30-year fixed rate mortgage means that somebody could buy today, and then they can let the power of time and inflation work to their advantage. All right, so that's gonna wrap it up for today's video. I hope the information here serves you. I hope you found value in it. If you did, found any value in it whatsoever, please consider hitting that like button. Subscribe if you'd like to see more content regarding building wealth in real estate, and we'll see you on the next video. Thanks so much.